The U.S. stock market is now closed for the weekend. As of the final bell on Friday, November 7, 2025, shares of BigBear.ai Holdings, Inc., ticker BBAI, finished the session at $5.67 per share. This represented a small gain of just under 0.18% on the day, but that simple closing number hides the reality of one of the most violent and high-volume trading sessions the stock has seen in months. The expectation was likely for a quiet drift into the weekend, but the reality was a high-stakes battlefield. The stock opened at $5.44, was aggressively sold down to a morning low of $5.29, critically breaking below its 200-day moving average before a massive reversal in the afternoon propelled it all the way to a high of $5.72, ultimately settling at $5.67. This wasn't a drift, it was a war. And the volume tells the story. Over 78.5 million shares changed hands, a figure that dwarfs its already high daily averages. This is not the chart of a company quietly waiting for news. This is the chart of a company where bulls and bears are placing massive, convicted bets right before the curtain is pulled back. What everyone is positioning for, of course, is the main event. BigBear.ai is scheduled to report its third quarter 2025 financial results on Monday, November 10th, right after the market closes. This earnings report has become the focal point for the entire narrative surrounding the stock. The general belief, the one circulating on forums and social media, is that BBAI is a high-growth AI company, a potential mini Palantir that is deeply embedded in the national security and defense sectors. The expectation is for growth, for contract wins, and for participation in the artificial intelligence boom. But the reality, at least based on Wall Street consensus, is far more troubling and creates the tension we saw in Friday's trading. Analysts are forecasting a loss of around 6 to 7 cents per share, which is wider than the loss reported in the same quarter last year. More importantly, the consensus revenue estimate is pegged at approximately $31.1 million to $31.8 million. This figure represents a staggering year-over-year decrease of around 23 to 25%. This is the central conflict. How can a company at the heart of the AI defense narrative be facing a double-digit revenue decline? The answer lies in the company's past performance and its reliance on lumpy government contracts. Last quarter, the company missed revenue estimates, which it blamed on lower volumes from specific U.S. Army programs. That miss triggered a nearly 16% single-day collapse in the stock price. With that memory fresh, the market is now divided. The bulls who bought the stock off its $5.29 low on Friday are betting that the revenue decline is temporary, that the company will announce new significant contract wins, perhaps related to the massive $170 billion in supplemental DHS funding, or the $150 billion for disruptive defense tech. They are betting on the narrative of its technology, like the Vane platform recently demonstrated at the Project Convergence defense exercise, to translate into new, booked revenue that offsets the old program roll-offs. The bears are looking at the consensus estimates and betting that the slowdown is not a blip but a trend, and that the stock is overvalued given its negative earnings and shrinking top line. The options market is reflecting this enormous uncertainty, with traders pricing in a potential post-earnings price swing of over 16% in either direction. This brings us to the short-selling activity, which is a major part of the BBAI story. There is a huge amount of short interest in this stock. Depending on the source, the short interest as a percentage of the free float is sitting at a very high 17.7%, with some estimates pushing closer to 20%. That means for every 100 shares available to trade, nearly 18 are held by investors betting the price will go down. This is the figure that gets a lot of retail investors excited, with discussions online frequently pointing to this as a sign of a potential short squeeze. The expectation is that any good news on Monday could force these shorts to buy back their shares, amplifying the upward move. But again, we must look at the reality beneath that headline number. The days to cover, which measures how long it would take all shorts to exit their positions based on average volume, is very low, at just over 1 day. This is a result of the stock's massive trading volume and means shorts can get out very quickly if they need to. Furthermore, and this is the most important piece of data, the short borrow fee rate is incredibly low, sitting at just 0.57%. This is not a typo. When a stock is difficult to borrow and shorts are desperate, this fee can skyrocket to 20%, 50%, or even over 100%. A fee of less than 1% is the reality. It suggests that large institutions, like the Vanguards and BlackRocks, who are top holders, are perfectly comfortable lending out their shares to short sellers and do not fear a sudden, uncontrolled squeeze. This doesn't mean a squeeze can't happen, but it does mean the technical setup for a sustained, systemic squeeze is not currently there. The high short interest seems less about a hard-to-borrow panic and more about a deep, fundamental disagreement on the company's valuation ahead of a risky earnings print. For investors trying to navigate this, it's useful to know where to look. You can find official short interest data published by the exchanges twice a month. For more real-time data, you can look at platforms that track borrow fee rates and the availability of shares to short. Another critical, though often overlooked piece of data is the fails to deliver, or FTDs, which is published by the SEC. This data shows when a party fails to deliver shares to complete a trade. While the most recent data is from September, it did show some significant spikes for BBAI, with over 1.8 million shares failing to deliver on a single day. Some interpret high FTDs as a sign of market stress or naked short selling, though it can also be due to clerical errors or settlement mismatches. Monitoring this SEC data can give you another layer of insight into the market's plumbing for a specific stock. What's your take on that high 17.7% short interest? Is it a sign of a fundamental problem or just a crowded trade? So what does BigBear.ai actually do to warrant this level of attention? The company is not just a concept. It's a provider of artificial intelligence-powered decision intelligence solutions. Its primary customers are in the U.S. government, specifically national security, defense, and the intelligence community. Its business model is built on providing what it calls decision dominance through its AI modules that it names Observe, Orient, and Dominate. This is about taking vast, complex data sets and providing clear predictive insights for high-stakes decision-making. Its acquisition of Pangiam in early 2024 significantly bolstered its capabilities in biometrics and digital identity, leading to real-world deployments like its biometric system now in use at Chicago O'Hare International Airport to speed up international travel. The bull case rests on this technology. They are not just selling a generic AI platform, they are selling a specialized tool for defense and security, a market that is non-cyclical and poised for massive investment. The institutional ownership reflects this serious use case. This isn't just a retail-driven stock. About 35% of the company is held by institutions. The top holders list is a who's who of major asset managers. Vanguard holds nearly 21 million shares, and BlackRock holds over 20 million shares. Major quantitative funds and trading firms like Citadel and Renaissance Technologies also hold significant positions. This smart money presence adds another layer of complexity. These firms are not momentum chasing. They are in this stock for a specific reason, but their presence on both the long and short side is what is contributing to the violent price swings as they position and reposition around key events. Looking ahead, beyond Monday's earnings report, the future for BigBear.ai is a true binary. The primary risk is its heavy reliance on government contracts. As we saw last quarter, a delay or reduction in a single large program can wipe out a huge portion of its revenue. The upcoming earnings, with their 25% projected revenue decline, are a stark reminder of this risk. The company is also in a shark